Off we go.
Welcome everybody to the Real Estate Investing for Busy Professionals group. My name is Daniel Homand. Today is November 4th, 2022. And welcome here everybody. Today is our monthly group discussion talk. And so I actually created just a couple of slides, a mini lesson to add value at the very beginning to talk about strategies for a rising interest rate environment. But other than that, I'm hoping that, that'll take maybe 20 minutes top, and then we can just have an open discussion for the rest of the time. So get ready with your questions. And if you know a topic that you want to talk about, like put it into the chat, or say it right now if you just know what it is. But if you need a little bit of time to think, put it in the chat. I see Ashish is going to say something. Hey, Jennifer, did you have a topic? What? Okay. Well, then, I am very happy to say that after having the data deleted twice, Jennifer, I'm going to have to mute you. Oh, Glenn, can you mute Jennifer? Okay. All right. I'm very happy to say that after quite a bit of time of doing data entry, we finally have our Speaker Hall of Fame back. And I'm going to show it right here, right now. Oop. Let's see. There we go. All right, and so I'm still in the process of adding data to this page here, but the names, the email addresses, and most of the videos are all linked up now. So thank you for, hey, could you guys do me a favor? If you are not speaking, could you put yourselves on mute? That's usually one thing I kind of do in the background. Glenn, sorry to stick you with that. If Macy's on the line, she could help out too. She's a co-host. So over the past few weeks, we've had Whitney in talking about investing in car washes, Keshav talking about build-to-rent properties, Matthew Pollard talking about motivation, Chandani talking about, that is the wrong title for Chandani. She talked about mentorship in short-term rentals. All right. So feel free to check this out. I am going to drop the link into the chat here, and I will also relink it up to the left-hand sidebar on our SharePoint page that is internal to Intel. Very shortly also, I'm going to make these things available to a private group where we will only admit Intel people or people who have retired from Intel, and I'll do that on Facebook. All right, so, and with that, also I wanted to show you our Facebook group, which is here. And I'm going to have to, here, no, there we go. It's called Real Estate Investing for Busy Professionals. And I am really looking forward to being able to have conversations in here. Yammer just hasn't been a great way to have conversations, unfortunately. And so this group is going to allow us to live stream our videos here. People that are retired can also access it here. We're going to be setting up events, so if you want to access this group this way, you can. And there may also be other people from other REI groups. Matt over here is running the REI group at Dell. Macy's running the REI group at Walmart, and Keshav runs the REI group at he does Facebook and Amazon because he's he did one and then switched jobs. So those people may be coming in here a little bit more, but we're trying to revive this group and add conversation here. So feel free to jump in. Anybody can post. You're going to get a welcome message from all of us, and just make sure that it's on conversation and it's not putting your latest deal up or things that might be considered kind of spammy. We are going to regulate the posts that go on here just to keep it conversational and discussional and of value to the group. All right, so that That is right here if you want to join. Oop. Facebook groups, REI for Pro, that's real estate investing for busy professionals. And if you need a QR code, it's right here. Does anybody have any topics that they want to talk about after I go through 8 quick slides on strategies for high interest rate environments?
Hey Daniel, this is Ashish. If we get a chance and there's interest, I would love to sort of share what my journey and the stuff I do both for real estate and outside of real estate.
Yeah.
In case that provides anybody ideas on future.
Are you wanting to share at a future date, or do you want to do it during
No,
the
not
discussion?
a future date.
Okay.
And then
we're actually totally booked up for this year, but we can put you at the beginning of next year.
Perfect. Yeah, that's a good forcing
unless
function.
You want to do like Christmas week, and which case, yeah. We're going to actually. I should probably pull up the calendar here. We've got, I believe, 5 more club meetings this year. We're not doing one after Thanksgiving. We are not doing one Christmas week, and I think maybe the 3rd week of December. I didn't schedule one also, but there should be this one and 4 other meetings that we're doing still, and they're all booked. We have guests for all of them currently, and so Ashish, we can put you at the top of the new year.
That's good.
I'll send you the link to sign up for a date. All right. Hey, everybody, be thinking about topics to talk about in a general discussion. We do our general discussion once a month, and it's just a time to share whatever your current deal is, whatever questions you have, worries, fears. Open and just have an open discussion. Some of the discussions that have worked really well is how do I set up my LLC, and just logistics and timing, and how do I screen my renters. That was another good discussion. So feel free to pose any question and we'll talk about it. All right, so strategies for a high interest rate environment. And these are obviously, anytime that you're getting into an environment where the cost of money is higher, right? Prices are going up for borrowing money. You are going to have to get creative. And
hey, Daniel,
yeah.
Before you get started, I don't think it's just me, maybe it is, but your slides look like almost like they're in the blurred effect.
Yeah, let's let us do this.
I know my eyesight's getting bad as I age, but
how's that?
Oh yeah, that's clear.
Yeah, it's much better.
Okay. And I disappeared from the bottom, right? I'm not, my video's no longer there.
Your video's no longer there.
Okay, good. Okay. So getting creative. Right now in our current environment, we can't assume that prices are going to be, or that cash flow is going to be available when you're buying properties. And so being creative and creating cash flow on your property is going to be very key at looking at deals that are coming up. And so I just want to share with you a couple of ways that you can actually keep the existing loan on the property, but still purchase or control that property. Right now in the United States, the average mortgage rate is 3.14%, which is significantly lower than what our current interest rates are. And actually, speaking of current interest rates, the big news of the day, I'm sure you all heard this, was that the Fed raised fund rates another 3/4 of a point last yesterday. And there's a lot of expectation that they will continue to raise rates, although Jerome Powell has indicated that rates may slow in their raising in future Fed meetings. If you look at the 10-year chart of the Fed funds rate, and just in case you don't know, the Fed funds rate is the rate at which the bank is able to borrow money from the Fed. So we all borrow our money from the bank borrows its money from the Fed. When the bank borrows money from the Fed, they're able to do what's, they have a reserve requirement of 10%. So for every dollar they borrow from the Fed, they're able to turn around and loan $10 out. And that's how a lot of liquidity is put into our, our capital markets. During, 10 years ago, we were recovering from the Great Recession. The Fed policy was highly stimulative. Fed rates were extremely low and stimulating the economy all the way till about 2016, which is where they started to go up. And going up is actually a healthy thing. When you have a healthy economy, you want to not overstimulate it. You can think about this as you know, an accelerator to the economy when the economy is not doing well. But when it's doing well, you want to decrease that acceleration and let the economy itself run without stimulation, because as we've seen here, it's possible to overstimulate the economy. If your productivity in the economy falls, like during a pandemic, and liquidity goes way up, then you have inflation that takes off. And the only way to really bring down inflation is to raise interest rates and to slow the economy and slow transactions within the economy. So that is the policy that the Fed is pursuing right now. They've indicated they're going to continue raising rates, but that it might be at a slower percentage in future meetings. I found this tool, which is a really cool tool. You can come here and click on dates for future Fed meetings. And this company, cmegroup.com, actually gives percentage distributions for what they calculate the likelihood of the Fed rates fund will be on that particular date. So for instance, on May 23rd of next year, they are forecasting there's a 40.3% chance that Fed fund rates will be 500 to 525. And of course, right now they are 375 to 400. All right. So I will, oh, that's my screen. Go back to this. All right, so I'm going to go through these quickly so we can get to our discussion. But the first thing you could look for is an assumable loan. There aren't very many assumable loans out there. Assumable loans, the most common place you'll actually find them is with FHA and VHA loans. But a lot of mortgage lenders phased out assumable loans quite a while ago, but they still exist out there. So an assumable loan is a loan that you can go to a seller and say, hey, I'll take over payments on your loan and I'll do it with the bank's permission. So in this case, you're actually going to the bank, you're letting them know that you're going to buy the house, but you'd like to keep the existing loan. They will put you through their credit check process and, you know, check your income and whatever they need to do in order to verify that you're a good borrower. And they will put their stamp of approval on it and say, okay, you can assume the loan. And with an assumable loan, you might be able to find a loan that's at, you know, 3%. 30% of mortgages right now are in the 2% range. So there are a lot of very low percentage rate loans that are out there. And these people are not likely to sell, but if they need to sell, it's obviously a huge boon for you if you can take over a low interest rate mortgage. The second way to take over a mortgage is to do a subject to loan document. These can be a little shady, perhaps, because this is you saying that you're going to take over the payment from a seller, but not with the bank's permission. In fact, a lot of times the bank isn't even informed that you're taking over the payments. You just start making them. The reason why I say this could be a little shady is because although it's done, the problem is that the person who sold the house to you still has the liability for the loan. Even if they, you know, signed the house over to you, the mortgage is still in their name. You're just making payments on it. So there's no legal guarantee that would keep the new buyer necessarily paying them, other than the fact that he doesn't want the bank to foreclose on the house. So subject to loans do exist out there. There are good reasons to do them. But if somebody is suggesting a subject to loan to you, I would say seller beware. All right. The next way to buy real estate, and this is the way that I'm looking at it more and more, is buy the business that's using the real estate. Hey, if real estate is not cash flowing like it used to because interest rates are high, maybe there are ways that you can increase the cash flow. And one of them is to buy a business that's associated with the real estate. Now, many laundromats will just simply lease the property, but some places, maybe auto shops, laundromats, financial services, gas stations, warehouse, some businesses will actually own the land that they are using. In this case, that's a great way of adding extra cash flow on top that might be able to subsidize the land purchase. So buy a business with your real estate. And I think there's going to be a lot of opportunities in this area right now. There are a lot of baby boomers that are retiring, a lot of people that just want to be out of the business because of the economy. There are business buying opportunities that are coming up, and I actually see this as potentially an area that will boom in the next couple of years. All right. The next thing we're going to talk about is a strategy. I'm not sure that a lot of people know about this, but this is called lease options. And a lease option is a purchase contract with pre-negotiated terms that combines a rental agreement and a option to purchase a home. And so let me go through and explain option to purchase a home really quickly. Just like stocks or commodity futures, you can purchase real estate with an option. And when you have a real estate option to purchase, what that is the person who is selling you the home is going to go into a contract with you and say, I will give you the right to buy this house for, whatever price, maybe $100,000 or $400,000 nowadays. So I'm going to give you the right to buy the house for $400,000 for the next 2 years. And if you exercise that option, I am forced to sell it to you at that price. And during those 2 years, I also am not allowed to sell it to anybody else. So this is exactly what a stock option is too, right? When you get a stock option, you have a strike price, and you might have the right to buy the stock at $50 a share or whatever it happens to be. And you can exercise that option, or you can let it expire. And that's the same thing with real estate options. They can be exercised, or they can be left to expire. One other interesting thing too is, just like stock options or commodity futures, you don't necessarily have to exercise or expire the option. You can also sell the contract itself. So if you don't want to buy that house for $400,000, a year later, but your friend does, or your business partner or somebody else does, you can sell them the contract and then they could buy it. So it's a flexible contract that allows you to purchase in the future. Now, how does this work in relationship to low mortgage or high mortgage rates? Well, there's something called a sandwich lease option. And this is a little complicated, but this will allow you to control the property, install a renter, and then eventually sell the house to that renter, all without modifying the mortgage until you're selling to the renter. So the way this works is you get an option to purchase a house from a person who wants to buy a house. They say, hey, I'll sell you my house at $400,000. And then along with that, you also get a contract so that you can sublet the house. So you say, I'll take over the payments on the house, and I'll take over the expenses on the house. In exchange, you give me the right to install a renter in the house, and I have the option to purchase the house in the future. Then you go find a renter who might be, they're a new person in corporate America. They've been saving up their money. They want to go buy their first house. So you go talk to them and say, hey, how would you like to rent this house for a period of time and build up your down payment? And when you're ready, you can purchase it. So you go to them and say, okay, I will sign an option agreement with you, the tenant buyer. And I will sign a rental agreement with you also that allows you to rent the house. And within 2 years, you can purchase the house from me. And so what that does is it makes you a middleman of sorts in the transaction. And let me show you in a little more detail how this would work. So let's say the seller's house is currently worth $90,000. After repairs, it's worth $100,000, and it's got a $72,000 loan. You might go to them and say, hey, I'll offer you $85,000 for your house. And but I want an option to purchase your house at $85,000. And I want the option to last for 2 years. You then pay them what's called an option deposit or upfront money for them to give you the option contract. And this is usually pretty low. It's usually much lower than, you know, a down payment on a house, but just some upfront money that you're going to be paying the seller to have them move out and give you the ability to take over the rent payments or to sublet the house. They are currently charging, you might say that if it was currently being charged, I'm sorry, you're going to pay them $710 to, sorry, I don't know why Misi is calling me right now. You might pay the seller $710 a month to rent the house. And when you eventually exercise the option, you will go and pay them some amount and get a mortgage for the rest. So this amount will probably be paid to the bank, and the bank will pay out the seller and give the mortgage. So when you turn around and sublet it and you find a tenant buyer, you say, hey, I'm going to give you an option to purchase the house at $105,000. And one of the reasons why they might do this is because it might be several years down in the future that the house might, you know, change in value during that time, or it might not. You say, I'm going to ask her $5,000 down from the tenant buyer, and you're going to, let's see, and you're going to rent it out for $995 a month. I forget what this statistic is here. Anyway. So the way that this pans out at the end is that the difference between your 1K deposit and the 5K you're collecting from your renter is 4K. So at the beginning of the transaction, when you install the tenant buyer, you get $4,000 into your pocket. You're going to make money on the spread of the rent you're paying the seller versus the rent that the tenant buyer is paying you. And at the close, the house will be, you will exercise your option to purchase the house, and then the tenant buyer at the same closing will exercise their option to purchase the house. So oftentimes you can actually put these into the same closing or make them the same day. You want to make the mortgage company aware that you're not going to be taking out a mortgage loan on this. The mortgage is going directly from the seller to the tenant buyer. And so at the end, you will take the difference here between the amount that you said you would buy it from versus the amount that you would sell it at. So you get paid on the front, you get a spread in between, and you get paid on the back end. And that's a way that you can make money without ever taking over, or I'm sorry, without ever having to create your own mortgage on the property. All right, that was just a little bit of food for thought.
Hey, Daniel,
Yeah.
I've got questions on that scenario. I assume that this is all assuming you have a motivated seller for some reason, because if I were the seller, I wouldn't see a reason to agree with any of this, right?
You can certainly change the terms, but yeah, you're looking for motivated sellers.
Okay.
I mean, 1K is a very small deposit. You know, they might be asking for quite a bit more for that.
Well,
but it
also,
just depends
I
on the
mean,
scenario.
You know, why would a seller agree to an option to sell for less than the home value, right? What's in it for them?
So you could agree to a full home value price here too.
Oh.
I mean, that happens.
Well, some homes don't qualify for conventional loans, so maybe that could be an option why it's cheaper than the current home value as well. Daniel, I do have a question. So the monthly cash flow that's for rent, does that also bring down the purchase price at the end of closing as well, or is that just?
Yeah, you absolutely can. You can say to the tenant buyer, hey, I'm going to charge you slightly more than the rent, but we can apply that difference to the purchase price of your property. So you could bring the back end payment down a little bit and the monthly cash flow up a little bit by crediting the buyer. So basically they're building equity in their house as they're renting it and eventually buying it.
Would you say this becomes a popular option in a rising interest rate market? Lease options?
Well, the lease option allows you to control the property. You have the right to buy it. Nobody else has the right to buy it, but you're not changing the mortgage at that point. So that's the reason why it would be interesting, at least to the buying party, when interest rates are rising.
So, but the buying party, once they take over the property, they still have to get a loan, and it could be a high interest rate, right?
Yep, they do.
Yeah.
All right. I haven't been monitoring the chat here.
Hey, Daniel, maybe just as a follow-up on this one, I'm wondering whether this is really in the rising interest rate environment or not. And what I mean by that is in the rising environment, you may not necessarily have motivated sellers yet. The amount of property and the amount of market decline in general typically tails later, right? Whether that's the stock market, whether that's unemployment going up and so forth. So I'm wondering if this is a strategy that's really used as the interest rates are rising, or in fact maybe after they've peaked and the Fed starts to ease off on its restrictions, you might find later in this cyclical behavior, a better opportunity where you still have what was originally a lower interest rate loan, but the rest of the environmental conditions are creating the motivation.
Yeah, the motivation is all going to be, there's going to be a lot of motivation determined by the environment. It ultimately comes down to finding a motivated seller. One thing I would say here is that in rising interest rate environments, there are a lot of people that have, lower interest rate mortgages by definition, and those people aren't going to be motivated to sell. So you might have a large number of people in this sort of environment that are not motivated to sell. And obviously the strategy depends on you finding a motivated seller.
Hey, Daniel.
Yeah.
Just follow up on that. So basically, how do you find a motivated seller, or how do you, let's say if somebody, your real estate agent, or would they know?
Yeah, that's a whole huge topic in and of itself. You see, a lot of people teach, you go stick out signs on the side of the street and say, "We buy houses," and that's, in part some of the strategies that people use.
I see.
But honestly, there are a lot of ways you can do it. You just need to find a motivated seller. Now, if you go through a real estate agent, they're not going to get their commission if you use a lease option, so they're never going to recommend you do this. So it has to be a direct to seller type of transaction.
So Daniel, regarding the subject to, where you officially don't assume the mortgage, I've heard usually there's an agreement between the buyer and the seller that if the buyer stops the payments, there's some recourse the seller has against the buyer. That I don't know if those are enforceable in the courts, but yeah.
I'm sorry, could you repeat the question there?
What I said was, and there wasn't a question, it was a comment that, the one you said subject to loans are shady because you're basically taking over the house, you have the deed, but the seller still has, on paper, he's responsible for the mortgage, right?
Yep.
So I've heard that often the seller and the buyer, sign some kind of a contract so that there are penalties for the buyer if they stop making the payments. I don't know, if they're enforceable. Like, you probably have to talk to a lawyer on that. But that gives the seller, in a sense, it puts the seller at ease that they still won't, in a sense, won't be on the hook.
The other risk in a subject to style loan, and I saw Sunil's question on, is an assumable loan the same as subject to? The main difference there is assumable loan, the bank is involved, subject to, they're not. But if the bank ever gets wind of the fact that you have a subject to loan, usually most mortgages have what are called due on sale clauses. So if it's sold, the mortgage company can come back to you and say, hey, you sold the property, the mortgage is due in full. So they can enforce that, which obviously torpedoes your deal.
So one question, why would a bank allow assumable loan? Let's say if somebody has a house and now the interest rate has gone up, house price is also up, but to make a buyer interested more, they can say, oh, you don't have to go refine and get your new loan, higher interest, you could do the assumable loan.
Mm-hmm.
So then I will have to go to a bank and say, oh, I want to do a assumable loan. Will the bank allow?
Oftentimes banks do not like them because they want to make sure that they are getting all their origination fees, that they're doing all the credit checks,
or higher
you
interest
know.
rate. Yeah.
Exactly. So assumable loans are actually more common in the commercial mortgage space than the residential mortgage space, but they do exist in both. But you're right, they're not common for the reason that the mortgage companies want to make sure that the new buyer goes through the whole process and originates a whole new loan.
So in that case, some people choose to do subject to loan, right?
Yeah. So obviously, check out your local laws. There are definitely local laws that pertain to these as well. I'm just throwing out there strategies that are done, and they work in certain locales, they don't in others. It all depends on your particular situation. Lease options are fairly universally used. These are fairly common.
Loan is more common among some relatives or family doing real estate property transfer or something. I don't know, just guessing. Because you do it with close friends and family rather than unknowns, right?
Or with a lawyer who knows how to make all the agreements so that the seller can be put at ease. All right, so that's the end. I'm going to just open it up to group chat. And if you have I'm gonna stop talking, even though that can be hard for me sometimes, and just let somebody else propose a topic and we'll talk.
Are you sharing the slides, Daniel?
You mean like as a PDF?
Yeah.
Yeah, I could do that, sure.
I just missed the entire presentation, so I thought at least I can take a look at it. But
I'll share them right now, actually. All right, so what would you guys like to talk about in the group?
Yeah, there's just a lot of things people are talking about.
Lately, I'm hearing about some like news. Can you hear me?
Yes, I can hear you.
Yeah, lately, I don't know. I've been just hearing something about called what's it called CBDC, central bank digital currency.
Okay.
So I don't know. I mean, it's more like an innovative idea of doing the banking system, right? So I wanted to know how that plays out with the real estate environment.
I'm not an expert on this topic at all. I did hear last year the Fed put out a paper that was a roadmap to digital currencies, and the date that they mentioned in the paper was 2025. Whether that happens or not, who knows. But okay, so here's what I know about digital currencies. The idea is basically that like a Bitcoin, dollars can be made into a digital currency, and then the Fed would issue, digital dollars. It would allow them to more tightly control various levers that would allow them to hit their mandates of low inflation and high employment. A lot of people don't like the idea of really tight monetary control, and a lot of people do. So it's a hotly talked about, and there are plenty of conspiracy theories surrounding it.
I'm curious, what's everyone's investing plan for like the remainder of the year? Are people more in the sit and watch position, or are people actively looking for different investing options to hedge inflation and put yourself in a good position for potential recessions and volatilities in the job market and volatilities in the interest rate market and other areas?
I'll add to that. Are you doing anything to prepare your end of the year taxes?
Yes, I am. Speaking of that, I need to, yeah, I have a meeting with my CPA in an hour actually to review where our taxes is at this year. And we'll have a webinar on it as well. Actually, I did post the webinar details in the Facebook group if anyone wanted to attend. We'll have that CPA firm sharing about some of the end of the year saving strategies, tax saving strategies for real estate investors.
All right, so open question. What are your end of the year investment strategies? What are your end of the year tax strategies? And what are you currently working on? Or maybe why are you not currently working on it?
I'll say something. So
Yeah.
for me, I am I'm purchasing a conservation easement, so I can offset some of my taxes based on what I've gotten this year. So this will be my first one. So I'm curious as to if anybody else has tried it and what their experience has been. But that's for me. That's what I'm planning to do.
What is-
Sorry, but what was that you were purchasing?
Can you guys hear me okay?
Yes.
Yes.
I'm purchasing a conservation easement, and maybe Daniel, you can tell them what that is.
Yeah,
Play it a little
sure.
bit better.
So I actually know that some people in this group have done that already. They've told me about it, and I actually did that this year also.
Nice.
But you know, it just went through like 2 weeks ago, so I can't give you any real feedback on it. But what I can say is I can share my screen here and go back to our previous Speakers Hall of Fame. And this guy, Michael Hazen, is the guy who spoke about it in our club recently. Basically what it is the federal government wants to encourage the conservation of untouched and undeveloped land. And so a lot of the, untouched areas, this is to encourage those areas to be set aside, and in perpetuity, they will not be developed. So you can look at different types of properties. You might just get forested area. You might find a rock quarry, but something that could be developed. And the idea of a land conservation easement is you go through and you have independent third parties establish what the value of the land would be if it were developed. And then you go to the federal government and say, our group is voting to not develop this land, but instead we'd like to make it a land conservation easement. And the federal government says, that's great. You want to save, land and keep it pristine and undeveloped. And so we are going to give you a tax deduction for doing that. And the tax deduction is a general tax deduction against your AGI. So you can deduct your W-2 taxes from it. You can deduct your capital gains taxes. It's not like a passive income tax deduction where you can only deduct income that comes from passive sources. You can deduct it from your overall AGI, and usually it's quite substantial. So it's a way, basically you'll put money into this investment, and your return is the taxes that you can deduct. And
thank you.
Why it says how to deduct up to 50% on your W-2 taxes. Federal government does not allow you to go over deducting 50% in any given year using this method.
So to add to that, thank you, Daniel. See, I knew you would be able to explain it much better than I. So once you purchase it, depending on what you purchase, you get a multiple of, I think you kind of explained that, but a multiple. So like if you put in 50, sometimes it'd be 5X. So you'd be able to get like $250,000 worth of deductibility on your taxes. And I think the rules are going to be changing because
Yeah.
You know, the government doesn't want you to have that much. I think it's going to be, is it 2.5 or something like that?
Yeah, currently for this year, it's a 5x multiple. At the beginning of next year, it's 2.5x. So, and it'll be decreasing on a yearly basis after that.
Yes.
I don't know to what extent.
They are tightening up all these loopholes that they've used for years and that we're just now kind of starting to use. So that's why, for me, it's like a 5x is amazing to me.
Yeah, this land conservation easements were introduced in the 1980s, I believe. I don't know exactly when.
Thank you.
All right. Cool, great.
Thank you.
Anybody else doing anything interesting? My voice cracks.
Yeah, I've been looking at mobile home parks, investing in mobile home parks in the last few months in that space. I feel the investment thesis is really recession-proof, considering that during the 2008 recessions, it didn't go down, it actually went up in terms of net operating income. The same thing with during COVID times as well. Interesting that since our GDP numbers didn't really show a recession, even though I think there may be a margin of error there, but I think it's good to be prepared for that and have some assets in some of this recession-resistant asset classes. So taxes is good, recession-resistant is good. I wonder what are some of the other things that people are thinking in terms of their investment, their freedom goals, right? I mean, at the end of the day, that's kind of the important part. Investing is just an instrument. So,
anybody else doing mobile home parks out there? And I'll also throw out anybody else doing short-term rentals. And how are your short-term rentals doing right now?
This is Ashish. I've done both. So I bought a mobile home park a few years ago, and basically you're right. The advantage is there was the Jobs and Tax Cuts Act of 2017 provides you a more than 100% depreciation right up front, right? So in my case, for every $1 I gave them, they give me $1.40 back in depreciation that I could use in year one. And then they turn around and sold the park like 3x, 3 years later, right? So I've already had an exit on that one. The numbers are becoming a little bit trickier now with the higher interest rates. So I've sort of paused my mobile home park. They were much more attractive 3 years ago. And it seems like a lot of companies aren't buying individual properties anymore. They're buying funds, these blended funds, which of course makes your taxes more complicated because now you've got a K1 that goes across multiple states. Short-term rentals, we bought one a decade ago. Boy, the occupancy's really dropped off, right? So, but what's interesting is if you have kids and you have a profit, you can pay your kids, assuming they're legitimately helping, right? In my case, the kids are legitimately helping with it. We don't have a property manager. And then we set up self-directed IRAs. So a minor can only, well, anybody can only save money into an IRA or Roth if it's earned income, if they have earned income. So if you can pay your kids for helping with your property, they can set up a self-directed IRA, right? Put up $6,000 a year. And then if you can invest in some of these funds, right, which give you some pretty amazing returns, if you compound that over 30, 40 years, it's just amazing, right? I mean, $12,000 becomes over $10 million in 30 years. So it's a risk I'm willing to take.
Ashish, I started doing that a little bit, but my kids didn't want to work very long. The job that I actually gave for them was I needed my file cabinet sorted. And so I said, hey, we'll pay you to sort my file cabinet, and that'll teach you all about the things that are inside it, and there'll be educational opportunities, and goodness knows I need it to be sorted. So that was what I did, and that lasted about a month, unfortunately. So it didn't turn into something where we could put it into an IRA, but it got a little bit sorted, and we just gave her cash.
So we don't have any kids, but one thing, my brother, I'm intending for my brother to come study in the US from China, and he's 15. And one thing that I heard from someone in my network about helping kids to learn the mindset of saving and investing is to, like, depending on how old they are, like if they're like, for example, my brother's 15 years old, you can give him $15 a month as an allowance, but then you can give him a saving rate of 10% per month, which is extremely high, right? 10% per month, let alone a whole year. But the point is to get them into the mindset of, sorry, not saving rate, a return. Like once they save, you basically kind of let them invest with you and give them a return of 10% per month. So that really trend them into the habit of saving and investing. So that's something I'm hoping to inspire my younger siblings on, something I didn't get to learn. So maybe that's something that can be helpful if any of you are parents and having kids.
Yeah, I would totally agree, Missy. And the third thing I'm looking at right now, which I'd be interested in the group's feedback, is trying to figure out, with the rising interest rates, how do you as a how do you get in front of it, right? So how do you actually take advantage of rising interest rates? Somebody's making a bunch of money. So what I've been talking to right now is these BDCs, these business development companies, not the publicly traded ones, right? The private ones. And these are basically private B2B lenders, right? There's probably 500 to 1,000 of these companies in the US. They lend out something like about $500 billion, right? They're huge. So companies like Intel, pension funds, right? The institutional investors will typically give these folks money to go lend out. And what's interesting is I'm personally focused on the lower middle market, the LMM funds, right? Which they will go lend to a business. So let's say, I'll give you an example, or let's say you live in a city and they've got a FedEx route, right, that comes open. FedEx routes are typically auctioned off, or an Amazon route, and you already own one and you want to go buy another one, right? But you need, let's say, a couple $1 million to go buy it. The banks will not typically loan you money, right? So they go to these BDCs to lend money, to borrow money, and then the interest rates over there are phenomenal, right? They're like 15, 20, 25%. And it's very low, like 40, 50% loan to value. So it's a very sort of a low risk environment. So has anybody done this, or is anybody familiar with this at all?
Where would we go in order to learn more about it?
Well, I am working with a company called Star Mountain Capital. The problem is some of these folks are, they're very high minimums, right? Unless you go in through an investing group, right? In which case they'll come down. But they also make for very good IRA investments, right? So you can go invest through an IRA. And they're typically, 15 to 25% a year returns, right? Historically, they've been like 25% a year returns. And they're very uncorrelated to the public markets. So recession, economy goes up and down, these guys don't care, right? Because they're just going out and lending money to fundamentally solid companies. The Star Mountain, for instance, has, I think they said they made like 200 loans in the last 8-9 years, and so far they're at 0% default. They say it's not going to happen forever, but has anybody looked at these at all?
I haven't.
I haven't either.
Sounds interesting though. I'm going to go look at it.
Yeah. I want, things like this. I'm thinking no investing is also maybe a good time because it leverages, essentially debt. Debt can be good. But the concept you mentioned about investing in good companies, it's kind of all like, even with syndications or just investing equity positions, it's all kind of similar concept. With the interest rate being higher, on one side, like as syndication companies were kind of forced to provide their higher than inflation returns to attract people. But I like the aspect you're sharing about the business development company. I've seen the names around, honestly, but I haven't been educated on that space. So maybe if you know anyone in that space, that might be a good knowledge sharing moment or session.
Yeah, I know several. So I just don't know if they'd be interested in coming in here, but we can certainly ask them and see if they'd be interested in coming in here.
Do they lend to? Is there a real estate component to their lending, or is it all just business-based lending?
No, yeah, sometimes, right? So, they'll do triple net sometimes. So
I'm getting more and more interested in just pure business, but hey, this is the real estate group, right?
Yeah, I mean, for me, the attractive part is I don't have to be an expert on who they're lending to.
Yeah.
Frankly, I don't care. All I'm looking for is a safe return.
Yeah. All right. Is anybody else out there doing hard money loans or lending of any sort that would actually, benefit from the higher interest rate environment?
I am, as long as someone's willing to pay me my my lending rate. Hasn't worked yet, but I'm ever hopeful.
You charging 100% interest, Glenn?
No, I wouldn't want to be predatory. I'm definitely south of 100. Two digits is good enough.
Actually, in hard money loans, 13, 15% is certainly not unheard of. In fact, I would say it's common. And I used to do that overseas. I used to live overseas with my wife. We were at a volunteer group, and we had raised some funds to help us live over there, but due to the exchange rate, it was starting to fall short. And so I started doing hard money loans to rehabbers, and I would charge 15% annual interest with a 6-month balloon and a point. So I'd get 7.5% on my money within 6 months and a point on the loan. And I did that over and over until 2008, where it didn't work anymore. I did it 5 times, I think.
I remember that story, Daniel. Has anyone read this book called A Recession-Proof Real Estate Investing? It's really
Is that another David Green book?
No, it's by this guy Jay Scott. I've already read it once, but I'm listening to it again. If anyone get a brief lesson on economics and just kind of how to profit in different cycles of real estate investing, I think this is a great book. I just
maybe we could do something like whoever invites the most people to the next meeting will get a free copy. Or just some sort of something to, I would love to give away books and figure out a way of doing it and make it worthwhile.
Yeah, that sounds good.
I have a question. Are these meetings open to non-Intel people, like this Zoom call? Can I invite my husband?
Yes, okay. Yes. So that question has come up over and over, and particularly with people who are leaving Intel and contact me and say, hey, I still want to participate in the group. And until recently, I've just said, sorry, it's Intel only. Now we're also streaming it to Facebook. And so
is that the link?
That's the link that's there.
Okay.
We're going to try and grow the group over on Facebook, and being in Facebook lets people that have retired from Intel, and I had, a couple of people that were going to Google from Intel and they still wanted to be here. But it'll let people in Macy's group join, over from Walmart. So yeah, it's open to the public now.
Awesome. Thank you.
And lots of details to be figured out.
Macy, thank you for the kid tips. I don't know if anybody thanked you, but I did appreciate those couple of kid tips, especially the interest rate, giving them back interest. I thought that was great. I'm going to try to do that with my kids.
Yeah, I think it's great, but be careful about compounding.
That is true.
Because it's a good thing. But I was actually I just launched my podcast yesterday. I haven't really told anyone about it. It's called. I'll put a link in here as well. It's about investing and freedom goals, pursuing the freedom goals and the freedom journey. Nice. But anyways, like every penny, if you have just one penny that doubles every day for the next 30 days, then at the end of the 30 days, $5.2 million. So just be careful of the interest rate you're given, so that you know what you're giving back as well.
I just want to highlight here, Ashish also added a investment calculator from Ramsey Solutions. I assume this is Dave Ramsey's site.
Yes, it is.
Okay.
It is very, very enlightening. The power of compounding. especially when you have kids, right, who have these 30, 40-year long.
Yeah, absolutely.
Unfortunately, my kids have discovered, like, Dad, someday I'm going to have $100 million when I retire. I'm like, yeah, okay.
I did my first mutual fund investments when I was 14 or 15, I think.
Nice.
And I lost money on them.
But at least you learned the lesson, right, Daniel? About
do real estate.
Yeah. And one cool nonprofit organization, in case you guys haven't heard about, it's called Junior Achievement. I volunteered with them before. They're basically like professionals like us. We would go to schools anywhere between elementary to high schools to teach kids about finance and workforce readiness and all that in a fun way. So we play games like Monopoly games and stuff with them. So if your kids are in a school and they haven't heard about the program, if you are on the parents board, you can talk them about it. It doesn't cost them anything. It's a nonprofit organization. So.
All right, in our last 2 minutes, I just want to share with you what we're doing for the rest of the year. We've got, this is the current meeting, but we've got John Bianchi coming in and talking about data-driven short-term rentals next week. I'm actually really looking forward to this one. Cooper Parks, he is a hedge fund advisor and manages a very large hedge fund. He's going to be coming in and talking to us about global equity markets, particularly with relationship to how liquidity is moving within the mortgage market. And then we're going to get a property management update. And I want to get all of the areas, California, Arizona, and Portland, these areas back in. Usually what we had done before in the past is we've invited real estate agents to come share about a local market update. So we're going to get a local market update for Portland on December 9th. And we also have the 16th scheduled, and I can't remember who it is. I'll have to go in my email to figure that out. But we're booked up, and thank you for being here. Have a great weekend.
Can everyone please take themselves off mute and say thank you to Daniel for his presentation today?
Thank you.
Thank you, Daniel.
Thank you, Daniel.
Thank you.
As always.
I love
Thank you,
being here with
thank
you
you.
guys.
Daniel.
Bye.
Thank you,
Bye,
Daniel.
everybody.
Thank
Thank
you.
you. Thanks,
Hey.
Daniel.